the day trust became a tradable asset. Trust was never meant to move at market speed. It was built slowly, earned painfully, and lost without warning. Yet in London, trust did not remain human for long. It became abstracted, quantified, and eventually exchanged. To understand why this matters now, we have to step backward. Because modern finance still runs on borrowed confidence. And when confidence becomes transferable, responsibility changes shape. Early London finance relied on names, not numbers. Who you were mattered more than what you promised. Reputation carried weight because failure carried consequences. A default was public. A betrayal was remembered. And trust functioned as restraint. But growth strained that model. Trade expanded beyond familiar circles. Capital flowed faster than personal knowledge. Relationships could no longer scale with ambition, so the system adapted. Trust was detached from people and attached to paper. Contracts replaced character. Signatures replaced memory. At first, this shift felt liberating. Transactions accelerated. Markets widened. Opportunity appeared more democratic. If trust could be standardized, it could be shared. If it could be shared, it could be multiplied. Institutions stepped in as intermediaries. They offered credibility on demand, not because they knew every participant, but because they promised to stand behind transaction. That promise became valuable, and once it became valuable, it became negotiable. Trust stopped being a moral constraint. It became an asset class, something that could be rented, rated, and resold. This was a turning point, when belief detached from behavior, and reliability no longer required familiarity. What followed reshaped markets permanently, because once trust could circulate independently, it no longer belonged to anyone. Once trust became transferable, it became scalable, and scale changed everything. Institutions grew into guardians of credibility. Banks, clearinghouses, and guarantors stood between strangers. Their presence reassured participants who never met. Confidence no longer came from familiarity. It came from structure. This created efficiency. Deals closed faster. Capital moved further. Risk appeared manageable through layers of assurance. But the system introduced a subtle shift. Trust no longer flowed from past behavior. It flowed from institutional permission. Ratings emerged to formalize belief. Symbols replaced judgment. Letters replaced experience. A simple mark could unlock enormous capital. At first, ratings reflected caution. They were conservative by design, slow to change, anchored in history. But demand increased. Markets wanted more assets deemed trustworthy, and pressure followed. As products multiplied, so did incentives. Those who judged trust were paid by those who needed it. Objectivity bent under volume. Standards softened quietly. Trust was no longer scarce. It was manufactured, packaged, distributed in bulk. Distance widened again. The origin of risk disappeared behind endorsements. Investors relied on symbols they did not question. Institutions relied on processes they did not revisit. The system rewarded circulation, not scrutiny. The faster trust moved, the more valuable it became. But speed has a cost. Verification slows transactions. Doubt interrupts flow. And flow had become priority. This produced a dangerous calm. Markets appeared stable because everyone believed the same signals. Disagreement faded. Independent judgment declined. Trust had become synchronized. And synchronized belief is fragile because when one assumption fails, it pulls every linked promise with it. The question was no longer whether trust could be traded. That had already happened. The question was what would happen when trust was questioned at scale. The first cracks appeared where few were looking. Not in headlines, not in prices, but in behavior. Small doubts surfaced, then were dismissed. An unusual delay, a missed obligation quietly resolved. Each incident explained away as temporary, because the system was not built to slow down. It was built to move forward, and forward momentum discouraged interruption. As trust circulated faster, scrutiny weakened further. No single participant felt responsible for verification. Everyone assumed someone else had already done it. This diffusion of responsibility became structural. Risk committees relied on ratings. Investors relied on institutions. Institutions relied on models. and models relied on trust remaining intact. When stress arrived, it did not announce itself. It crept in through hesitation. Lenders asked more questions. Buyers paused longer than usual. Liquidity thinned first. Confidence followed. The moment trust slowed, friction returned. Transactions that once closed instantly required explanation. Margins tightened. Collateral demands increased. This revealed a hidden truth. Trust had been masking uncertainty, not removing it. As pressure built, institutions faced an impossible choice: defend credibility at any cost, or acknowledge exposure and risk collapse. Many chose silence. Others chose reassurance without evidence. Few chose transparency. The system responded badly to doubt, because doubt threatened its core function: continuous circulation. When one endorsement failed, others were questioned. Ratings were reassessed. Guarantees were re-examined. Promises lost their assumed weight. Trust, once abundant, vanished faster than it was created. And because it had been synchronized, its withdrawal was synchronized too. What followed was not panic at first. It was disbelief. Disbelief that trust itself could fail. But failure was inevitable, because trust cannot be multiplied endlessly without eventually losing its anchor. When trust finally broke, it did not shatter evenly. It collapsed inward. Institutions that once radiated confidence absorbed fear instead. Every promise was re-examined, every guarantee questioned, every intermediary exposed. The system discovered something unsettling. Trust had been standing in for understanding, and once belief disappeared, nothing replaced it. Markets froze not because information vanished, but because certainty did. Participants no longer knew whose assurance mattered. The tools designed to create confidence accelerated its loss. Downgrades triggered withdrawals. Withdrawals triggered forced sales. Forced sales triggered more downgrades. Trust reversed direction. Instead of flowing outward, it evaporated upward. What had been a strength became a vulnerability. The more central an institution's role, the more devastating its loss of credibility. This was the paradox London confronted. Trust can connect strangers across the world, but when detached from responsibility, it can also connect their failures. The lesson was not to abandon trust. Markets cannot function without it. The lesson was to recognize its limits. Trust must be questioned to remain credible. It must be earned repeatedly, not assumed permanently. Today, the same architecture remains. Ratings still guide capital. Institutions still intermediate belief. Confidence still moves faster than understanding. The difference is memory, or at least the hope of it. Because what happened when trust became tradable was not a historical anomaly. It was a warning written into the structure itself. Sometimes the smallest shift in perspective becomes the beginning of a new future. The day